Hello traders, today is Friday, April 28th. I'm going to show you an oldie but goodie using price action, the at the open 2 strategy, where we look at how the market trades first thing as it pushes either up or down. And this is a method that we've taught traders for over 12 years, and it surprises me that it still works, it's still good. That means price action is the way to go. Now, before we begin, remember that trading is risky. Please don't trade with funds you cannot afford to lose, whether it be futures, stocks, options, currency, Forex. There's risks involved with trading. Now, if you haven't already opted into the DayTradeToWin homepage, you can get a free member account. We offer a free software. Download the free ABC software. We have some free videos. As long as you have a member account, you have access to all the latest and greatest from DayTradeToWin. Now, if you look at the chart, the only indicator I have is the ATR, the average true range, and I'm using a setting of 4. So I'm really only looking at the last 4, maybe 5 candles to help me understand what the market is doing or the movement that it's having. So you can see that value there on the E-mini S&P is 2 points, 2.25 points. And that means that every candle is working at a distance of 2.25 points. Now there's a signal. The signal is to go long. That's the at the open signal that indicates go long at this price, 41.57. So the software is telling you to go long, and we go to our dome or our chart trader and we place a trade to go long. Now I do have a few filters. I want to make sure that there's nothing conflicting. That's obviously important. And I also want to make sure that there's no news events, because a news event is an outside source that could move the market in either direction. So I want to avoid trading during news. I want to make sure there's nothing conflicting. So I'm just using price action to enter long at 41.57. Now, whether you go in immediately or you enter right at the exact price, it really depends on you. We try to follow the signal as accurately as possible. So 41.57 is the entry to go long. Now there's a little bit of a backup to this. If we don't get filled at 41.57 and the market continues higher, which means that we're unable to get this limit order or this market if touched order, there's a second option, and that's called the chase the trade. So in this example, we're trying to get filled at 41.57. Whether or not that happens, remember, price has to come down to it and either touch it or go through it. But if that doesn't happen, what you're going to see is a new order generated, and this is again done by the software automatically for an additional order to go long. So really the breakout that we're seeing is to the long side. I want to go long regardless if it's 41.57 or if it's at this new entry at 41.6275. So you only take one, you don't take both. You take whichever allows you to get into the market. So as an example, the 41.6275 entry to go long, at this point we should already be long, right? Because the market hit 41.6275, it retraced it, it's now moving above it. So I'm going to go long here at 41.6275, or as close to it as possible as I do this video here, and using a stop order. So the limit order is a retracement. A stop order is a continuation. So I had to use a stop order for that. Okay, now what do we do? Look at the ATR, the average true range. It says 2.25 points, 2.5 points right down there. That tells me that the distance the market should move in my favor, and what I need for it to do in order to be successful on this trade is for it to move about 2.5 points. So that's my goal, that's my target. Now I didn't get at the best price. You can see that I'm off by 2 or 3 ticks, unfortunately, but that's the price that I entered at, and that's what I have to work with. Now, let's say the trade goes wrong. Everything goes wrong. It just goes against us. What do we do? Well, we have a stop, as you can see, but that's not the only stop. We also have what's called a time-based stop. In some of the other methods we teach, they have prove-it stops as well as pivotal stops. So why do we have different types of stops? So as an example, I don't want to stay in this trade for a long time. This type of trade should almost be an instant move in our favor. And if it doesn't happen, 4 to 5 bars. I call that a time-based stop. Close the position, get out of the trade, and look for the next opportunity, whatever that may be. It could be scalping, it could be re-entering, but I don't want to hold on to a position if it's going sideways, or if I'm just holding on as it goes against me and against me. I want to try to cut it loose as fast as possible. So 4 to 5 bars after entry. If I'm not able to get the full target, we close the position. So the catastrophic stop that you see there is only intended if there's a catastrophe. Let's say that there's a news event and the market goes straight down. It's intended to protect us as a method of last resort. But instead, I want to use something else to exit this trade or to manage the trade, whether it be time, whether it be proof, whether it be a pivotal stop of some sort. And so in this case, within the 3 to 4 bars, the market moved in our direction. We got the target and consider the trade finished. Now, with the at the open method, this at the open 2 software, there's no reason to re-enter or to try again. You can definitely go long or go short using something else, a different strategy or a different method, but this specifically is only intended to be in, be out, and be done, and then shut down the computer. This is a once and done type of trade. Right as the market opens, first thing, as the day session begins, whether it be the London session or the US session or really any market. So this is not based on just the E-mini S&P. It can really be traded on any market. So that being said, let me show you what happened yesterday and on Wednesday. So 3 days in a row of using the at the open strategy. All right, so here we are with the same exact chart that you just saw the trade be taken. This is what the software is doing. It's giving us these 2 long positions, whichever one happens first. So that's really important, whichever one happens first. You don't want to take both. So this is today, Friday, April 28th. Now, if you take a look at what happened yesterday, we have another long position. This one was at 41.0550, right? So it's a long entry on the E-mini S&P, 41.0550. So I'm going to just analyze this trade here for a second for everyone. So remember, we're entering long. We look at the ATR, which is right here, and we say to ourselves, what is the ATR doing? What can we expect out of the market? So we're looking at about 2 points. And how far did the market go? Market went 3 points, or about 3 points right over here. So remember, when I look at an opportunity to go long, you have to ask yourself, what's the stop? You have to ask yourself, what is the target? I know what the target is. How do I manage the trade? Well, I'm only going to be in this trade for about 4 to 5 candles. And what's my stop? If everything goes wrong, you have to have some type of stop. Now, typically, when I look at the ATR, I really don't want to see it above 5 points, which is 20 ticks. And that's why I'm using a 1-minute chart, maybe a little bit more advanced for the beginner traders, but just know that when the market's overly volatile, it's not always great because you have also a lot to lose because it can go against you pretty quickly. So I like to stay within 1 point and 5 points here on the ATR scale. That's 4 ticks, between 4 ticks and 20 ticks if you're thinking about the E-mini S&P. Okay, so that is what happened on Thursday, the 27th. Let's take a look at the 26th, another day. All right, on the 26th, we don't have a long, we have a short. The short happens to be 95 to go short. So once again, what do we know about the trade? We know the direction. That's half the battle. I want to go short. I want to know an exact price, 40.95. So that's good. I'm not winging it. I know exactly what price I want to go short at. How do I manage the trade? I look at the ATR. I ask myself, what can I expect? What's my stop? And how long do I want to be in this trade? How do I manage this trade? So in this case, the ATR was 2.5, 2 3/4. You can see right there. So I want the market to move in my favor, 2 3/4 of a point. And you can see fairly quickly it went much further beyond 2 3/4 of a point. Now you can trail a stop. You could. It's up to you. But we're looking at once and done. Get in, get out, be done, shut down the computer. And that is what the At the Open 2 software is doing for us. This method has been traded for many years, and I think that it's one of the best price action strategies that exist. Now you can get the At the Open 2 strategy with accelerated mentorship, so we include that as a package, or you can get it on its own with a lifetime license. If you have any questions, visit DayTradeToWin.com. My name is John Paul. This is a 3-day review using the At the Open 2 strategy. Until next time, good trading. If you're new to day trading and want to learn more on the benefits of trading the markets, visit DayTradeToWin.com, join the next mentorship class starting later this month, and subscribe to the Day Trade to Win YouTube channel. We focus on price action and work exclusively with new and beginner traders who want to learn more on how to prosper from trading.